Don't quite understand it. Well, anyways, I'll make sure that I cut out this first part of it. I'll trim it off of the YouTube video. All right, so let's get started. Today was a range bound day. What we're going to do is we're going to go take a look at the charts and see what was in front of us today. All right, so off to the charts. All right, so this is a 1 minute view. This is not going to do us well. Let's back up a little bit to say 30 minutes. All right, and we're looking at about week and a half, week worth of data. We came into the market today right about here, and already we could tell that it was going to be range bound. I didn't think it was going to be as range bound as it was. I was really thinking that we could be as high as this green line up here, this LVN at 38.65, and go down as low as 37.50. That's what I was expecting. I was not expecting, just staying in this tight of a pattern. But anyways, when the market opened, it was pretty subdued, and we established a top and a bottom, an opening range, so to speak. And it was apparent that we were going to sit within that range. So around 10 o'clock, I decided to play both ends of the range. And what I did was, let's see if I can bring the Discord in here and show step by step what I did. So we will go all the way to the beginning of the market. All right. So at first I said I thought that for the rest of the week we were going to be somewhat range bound, and we would stay within this box and then eventually go down. So we had our bull market rally. We're doing a consolidation here. And like I said, I thought we were going to have a little bit more of an expanded range, but we didn't. And then once that opening range was established, it became clear that we were going to be really tight. So what I did was I had proposed two different spreads, one at the bottom of the range, one at the top of the range. And we were near the top of the range when I specified these, and so we were going to go for the bottom one first. So each of these boxes represents a butterfly, and we put it out of the money, and trying to get like a 1 to 10 risk to reward. The one that I put on was 20 wide and centered just above or right around this LVN, or here, this green line, this LVN, and then the other one overlapping the LVN as well. As a general rule, what we do is we try to put a butterfly over one of these major market structures like an LVN or the edge of a node. The LVN is a low value node, or the low part of one of these volume wells. And the idea here is that price is going to come up to that and either bounce off of it or pass through it, right? So either way, we can have an opportunity to profit. So the idea on down here was that by putting it right on the edge here, I wasn't so sure that we were going to just stop right at the LVN. I thought there was a possibility we could come down and maybe get a pass through, but it didn't. So we put this guy on right here. And so putting it in context, it looks something like this. So there was a trade right here. It came down and touched the edge and came partially inside of our butterfly, inside the profit tent. And so there was an opportunity to take a small profit. I think, let's see, what did I actually get? All right, so this is the actual performance right here. Um, I was able to put a 20 wide trade on with a 2.4 or a $2.40 debit out of the money, and it was a 1 to 7.3 risk to reward. So, that's a fairly okay trade. And had price gone deeper into that butterfly and hung out there all day, there was the possibility of making as much as $1,700. But that's not really the play. The play was to just try to capture profit as it sunk into the butterfly. And then the plan was that once we got down here, just see how it plays out and see whether or not we can hang out here for as long as possible until it started to move up. And as it started to move up, our profit started to diminish some, and I took it off. I was able to collect about $1. And at that point, put up another trade, but this one I felt we had the opportunity to go all the way up to this LVN, so I centered it on that LVN. So the trade up here the trade up here was also 20 wide, but it was centered on this LVN. So it came really deep into here. Now, during the day, at first, I wasn't sure that we were going to be able to get a price on this. As a matter of fact, it came too close for the price that I wanted, and I wasn't able to, get it under $3. And so I kind of turned my back on it for a little while. And then we came near the end of the day at 3 o'clock. We started doing the final hour trade, and price pulled back. You can see this little bar here that pulled back. Let's see if I can zoom in on a bit. So yeah, price. Let's see. I don't know if I have this to scale here. 66. This would be. Right about there. So price pulled back, and it triggered the trade. And got back in. Let's see, it pulled back. Where did it pull back? Right here. Oh, right here. Pull back right here. It started moving up. We were breaking out here. Here's where we broke out earlier in the morning, right around noontime. And so I told the group that it looked like it was going to break out, and that you should probably take profits. Let's see if I can show you that. Where was that note? Right here. So right here, I said that it looks like we were going to break out, and that it was a good time to probably take profit and start staging a trade for the upper end of the range. And so if we look back here, that was right here. Now, it moved pretty quickly, and by the time it moved up here, there wasn't really a good risk to reward. But I left the trade on, and then later in the day, at about 3 o'clock. Well, maybe not 3 o'clock, maybe around 2 o'clock, it pulled back, and triggered. Now I wasn't watching it. Um, I really wasn't watching it. I just had hung the trade out there, and it gave me my price. I believe I paid $2.50 then for the trade, and that's really a consequence of trading with Fidelity. Um, and it's actually I hope to alleviate that problem. I mean, I was Fidelity. I've been using Fidelity mostly because as a group we've been trading the SPX. And the SPX is fine for certain things. If you take trades inside the market day, you can get a good price in terms of commission on your trade. And if you're just going to trade within that day, it's okay. The big problem is if you have a smaller account, you're going to have to be very careful about being a pattern day trader because you can get tagged there. So, anyways, the other problem I have is that all my big account is in Fidelity, and that's the place where I can trade SPX. I have a toss account that really it's a much smaller account, and so I don't trade SPX there. I trade futures, and that's kind of to prove a point that if you have a smaller account, the futures are definitely a superior alternative, even with higher commissions. So, anyways, you're going to see us moving more over to futures in the near future, no pun intended. Perhaps starting as early as tomorrow, but definitely starting Monday of next week. Anyways, the trade pulled back here and then triggered and then came up here right into the LVN. I had started up the final hour trade of the day and started to to set up my stage trades, and I noticed that I had this position on, and so it was right here on the LVN, right, which was actually perfectly centered on the trade. So I decided to take it off for $11.75. I probably could have got more, but I I decided to you know take what I had and run. So the moral of this story is that when you're in a tight range and you're on one end of the range, you want to set your butterfly on the other end of the range so that you can get the proper risk to reward. If you come down, if price comes down to the bottom part of that range, like it did today, you can grab some profit and actually use that, even if it's not a big score. You could probably use that to finance, your next move. So I made on that score. I had two positions on and $1, so it's a couple $100. The next trade only cost $2.50, so really, I was only potentially going to lose 50 cents if the new trade was a bust. But didn't work out that way. That trade really came through and returned almost 400%. So that's what happened today. Let's come back to the. I know that here's the other thing that I wanted to explain what happened today. And this goes to what this service is all about. So we have a lot of traders that have been with us now for over a year. The service was started back in April of last year, and true to form, and exactly how I'm hoping different members will develop in the service is that most of those people have developed their own method. They have taken the things that I have put out there, the strategy, the analytical methods, the fundamental analysis that we do, and the process, and they've made it their own. And so there are a lot of great traders out there, and they basically run with it. So a lot of times when I put on a trade, they are already in a trade, or maybe they'll follow what I'm doing and modify their trade, and maybe wait to see where I entered and see if they can get a better price. So they've learned and they've made the trade their own, and that's really what I'm going after in this service is to give you the tools so that you can make this trade your own. The cool part about trading zero DTE, and particularly with out of the money butterflies, is that you can get a great risk to reward. This really is the perfect strategy, particularly going into this recessionary environment. And for a couple of reasons. One is that your risk is always extremely small. And you're not really worried about these big moves. If you get a big move, you can make profit by price just moving through your strategy and picking up the tail. Um, if you place a trade, very out of the money, you could potentially pin it. But the real advantage is that while price is coming down, while we're in this sort of recessionary bear market, the early parts of the day are kind of high volatility, and when you have that high volatility, what happens is premiums really expand, and so that allows us to put on trades that are primarily Vega negative. And that what that really means is butterfly is a Vega negative type trade. What that means is that when you have a lot of implied volatility, that tends to work against you if you're trying to make profit, but it works for you if you're trying to put on a good risk to reward trade. So in other words, it kind of lifts the whole butterfly strategy and allows you to put on a better. So your debits are much smaller, and your potential profits are much higher. So that's great for getting in, and that's typically the kind of behavior that we have early morning. Is a lot of volatility in a bear market, and that lifts the trade and gives us a better risk to reward and more premium to collect. As the day wears on, unless it's one of those days that is just a big cluster, um, implied volatility starts coming down. Now, as I said, the butterfly is Vega negative, so that works in our favor. So we don't have to be as accurate placing those trades, because as volatility is moving down, that means that premium is decaying faster. So even though you're on a zero DTE and you're expecting fast decay anyways, you get an extra push in these bear markets, and so you can get uh, basically you can get out of a trade very near to your max profit if you happen to be close to a center strike very early on in the trade. And also, if you're even outside of the profit tent of the butterfly, you can make quick profits. So what I'm trying to say is that this bear market, and particularly if we're going to be in this kind of bear market for some time, is providing the ideal environment for trading this type of strategy. And that is the zero dash DTE strategy, the out of the money butterfly, um, getting that kind of flattened uh, premium curve that gets bloated early on, lifts the strategy up for you so you can get a better risk to reward. Now you can you can go further out of the money and get wider spreads. So you have the potential to collect even more profit, and also increase your probability of touch because you're creating a wider spread. So yeah, that's really what I wanted to say. That this strategy, in my view, is perhaps the perfect recession friendly strategy. Super low risk, high potential profit, um, and then all the characteristics of it allowing you to set up the ideal trade. And today was, it was an interesting day because it was very tight. But most of the time we have these, really ranging days. But and even in those cases, we do fine. Um, so that's really it. I don't know if anybody has any questions, or if you agree or disagree with what I've said. But if you're not part of the service and you would like to try it out, go to zero-dte.com/try. Get a 4-week trial. Join about 50 traders that are all having a great time trading this strategy with super low risk, low anxiety, high potential profit, low drawdowns. And that's really a key in, this and as we approach and as we're going deeper into this recession. You want to hang on to what you have, right? So even if you had, say, a string of losing trades, right, you want to make sure that those losers aren't going to bite into your account. And so by putting on these asymmetric trades with tiny, tiny risk, that certainly is helping out. And that's another reason why this is a recession friendly trade. And you also want a trade that behaves the way you would hope that it would have the wind at your back, basically, in that type of environment. Now, of course, um, in a bullish environment, you also have that benefit of the Vega negative, but you have it most of the day. So you're not going to be able to, get the same kind of risk to reward. You can get it close, but what you are getting is that faster premium decay. And we showed this actually last year while we were in that bullish environment. You know, our win rate, skyrockets, and so you get a lot more opportunity. Price isn't moving all over the place. You have more deterministic market structures, and you can place trades in a way that give you a better chance of getting in. In a really tough environment like we have now, again, this strategy plays to those characteristics, and its unique characteristic allows you to make the most out of it and be really comfortable in trades and not have to risk a lot. Let's see. We got a comment. Enjoying more about this way. Much more fun trying to catch profit than cutting and running from credit spread losses. Yeah. So that's a really good point. That because the risk is so small, unlike other zero DTE strategies, they have to put on stops so that they don't risk an outlier trade or a trade that moves to their risk side of the trade, and their risk is totally inverted from what we have. So instead of like what we do, where we put on 1 part risk to 7 parts or 10 parts or even 15 parts reward, they're doing exactly the opposite. Where on a credit spread or an iron condor, they're putting on trades that have um, 5 parts, 10 parts, 15 parts risk to 1 part reward. And on top of that, they never really go for that whole reward. In fact, they get out as soon as they get 50% of it because they know that there's the gamma risk starts increasing as they get further on into the day, and the market could move towards the risk side of the trade and either threaten a max loss that could literally wipe out weeks of their profit, or they're going to hit their stop that they usually set at about 3 times the potential credit. So they are always working at trying to manage their risk. Everything that they do is all about managing how much they're going to lose. Where we take the exact inverse of that, we are spending all of our time not worrying about the risk, and we are managing our profit, how much we can win. I would much rather be trying to manage my profits rather than managing my loss. So that's another great part of this trade. Again, I just want to reiterate, I think that the zero dash DTE way is absolutely one of the best recession proof day trades that you can do. And in fact, I think that it's probably pretty good for slightly longer term trades too, maybe weeklies. Weeklies on some of the big tech stocks. I think it would also work out very well where you can take that tiny little risk and then go for that outside profit. You know, I put on a trade with Tesla, for instance, last week. Cost me $250 to get in, made $4,000 profit on it. I mean, I'll do that every week. If I can do that just, once a month, I'd be happy. But it's actually a much more performant trade than that. All right. That's about all I have to say. Thank you very much for joining me. Really appreciate it. And we'll see you next video. Peace. Oh, hi, Gloria. Nice to see you here right at the last minute. All right. Take care, all.